Major banks have long been seen as untouchable pillars of the financial world. They represent stability, trust, and the backbone of modern economies. Yet beneath this facade, cracks have been forming, some small, some dangerously deep. These cracks are no longer invisible. They are signs of a systemic weakness that most people overlook until it becomes impossible to ignore. The first sign comes from the changing dynamics of capital. Banks rely on deposits, loans, and investments to generate income. But shifts in global liquidity, rising interest costs, and complex derivatives have quietly eroded their safety margins. They appear solid on paper, yet the reality is that their assets are often more fragile than they let on. Next, consider the behavior of institutional investors. Many have started pulling back from banks they once trusted blindly. These investors read the fine print, they track risk ratios, and they notice the subtle decline in financial health. The moment confidence wavers, the ripple effect can be swift. A sudden withdrawal of funds or even a drop in stock prices can cascade into a crisis that seems to come out of nowhere. Technology has also reshaped the risk landscape. Fintech companies now compete directly with traditional banks, capturing market share in lending, payments, and wealth management. This competition pressures banks to take on higher risk ventures to maintain profits. Their need to innovate financially sometimes leads to over-leveraging and exposure to unseen liabilities. Another key factor is regulatory gaps. Governments and financial authorities often lag behind the rapid evolution of banking practices. New financial products, cross-border operations, and complex instruments can outpace the rules designed to keep them in check. The result is a system that looks well-regulated but harbors vulnerabilities beneath the surface. Public perception plays a surprisingly critical role. People tend to believe that major banks cannot fail, which encourages complacency. Customers continue to deposit money. Investors continue to buy shares, and the illusion of security feeds itself. This perception becomes dangerous when reality starts to shift. Once fear sets in, the very confidence that sustains the system begins to unravel. The interconnectedness of banks is another element amplifying risk. Large banks lend to and invest in each other. A problem in one institution can quickly spread, creating a domino effect. What starts as a small solvency issue can evolve into a regional, even global, financial disturbance. Past crises have shown that interbank dependencies are often underestimated until they trigger catastrophic events. Corporate governance failures also contribute. Decisions made at the top, whether overambitious expansion, risky acquisitions, or poor risk assessment, have long-lasting consequences. Accountability often emerges too late. By the time warning signs appear publicly, the damage is already deeply embedded. Emerging market exposures add another layer of fragility. Banks invest in global markets, assuming diversification will protect them. However, geopolitical instability, currency fluctuations, and sudden market shifts can turn this strategy against them. A market thought to be stable can suddenly become a source of significant loss. Liquidity management has never been more critical. In normal times, banks can rely on cash flows and reserves. But in moments of stress, access to immediate liquidity becomes a lifeline. When confidence falters, the demand for cash spikes, and even banks considered strong may struggle to meet obligations quickly enough. Technological failures, cybersecurity threats, and operational inefficiencies also weigh heavily. In a world increasingly dependent on digital infrastructure, even minor disruptions can amplify uncertainty and accelerate panic. Risk models, while sophisticated, have limitations. They are often based on historical data, yet history does not always predict the future. Unexpected shocks, black swan events, or cascading defaults can invalidate even the most careful calculations. The combination of these factors, fragile assets, investor sentiment, regulatory gaps, competitive pressures, global exposures, operational risks forms a perfect storm. It remains silent because day-to-day operations continue. Markets fluctuate moderately, and news rarely captures the hidden fragility. The collapse does not scream its arrival, it creeps in quietly. only visible to those who scrutinize deeply. Yet, ordinary people are rarely looking at these signs. Most focus on interest rates, mortgages, or their savings accounts. They trust the system blindly, unaware that the trust itself is a fragile currency. When the collapse accelerates, reaction is swift and chaotic, leaving little time for preparation or mitigation. Understanding the silent collapse of major banks is not about fear-mongering. It is about awareness. Awareness allows investors, savers, and the public to make informed decisions, to diversify risk, and to question what has been presented as absolute stability. It encourages a critical look at confidence, governance, and exposure. In the coming years, expect continued scrutiny, more cautious investment behavior, and a reevaluation of which banks truly provide safety. Some institutions will weather the storm better than others, but no bank is completely immune to systemic weaknesses. The key takeaway is vigilance and critical thinking, applied consistently. The story of banking is not just about numbers and balance sheets. It is about psychology, perception, and the fragile interplay between trust and risk. Those who understand the hidden vulnerabilities can navigate crises with foresight. Those who ignore the warning signs are caught unaware, and the consequences can be devastating. Keep your eyes open, question assumptions, and understand that silence does not equal stability. The cracks may be hidden, but they are real, and they matter. The collapse you didn't see coming is not a possibility. It is a lesson in how confidence and complacency shape the fate of the financial world. If this analysis gave you insight into the hidden workings of major banks and how to think differently about financial stability, make sure to subscribe and join the channel. More deep dives into financial risks and opportunities are coming your way.